Okay, so this work.
Okay. Okay. All right, we're recording. Cool. Welcome to the Unboxed show. This is Nick Jordan. I'm here with Eric Porper. Today's guest is a local venture capitalist. Well, I guess I don't even know if I want to say local for sure. I started, European, international. He's an international businessman. International businessman, entrepreneur, operator, successful exit, one or more, maybe a couple. Has now evolved into the venture capital scene and is running one of our local VC firms, Cofounders Capital. Maybe you give us a quick intro on yourself and what you're up to these days.
Yeah, right on. And I can apologize for you all having to listen to a German accent that doesn't seem to be going away after 15 years now in Durham. So yeah, exactly as you said, Nick. I background is grew up in Germany, went to school over there, had a hot start in investment banking for a quick second before I got bitten by the entrepreneurship bug, and joined three guys in Berlin, Germany as a second employee after the three founders for my first startup. That was back in 2005, 2006. That was a very, very quick flip. Company got bought very quickly, and I came over to Durham in 2008 to co-found a company here called Shoeboxed with Taylor Mingus, who went to Duke. I met him in Berlin working at that startup together, and he had the idea for Shoeboxed and asked me if I wouldn't want to come over here and to do this together, and that was my cue to pack a couple bags
Okay.
and come to the States. So ran that company about 10 years, sold it in 2018, and then I had to figure out what I wanted to do when I grow up.
Okay.
And I after a lot of thinking, ultimately did switch to the dark side, but trying to make it brighter.
Okay, there you go. 2018 seems both like so long ago, but not that long ago. I didn't know. I feel like if you guys sold Shoeboxed in like 2015 or something, or 2012, like I feel like you guys were so established early on and had a nice pathway to exit. But what was that exit process like?
Yeah, and I definitely agree. It's still funny. I feel like now thinking back to the pandemic times, like the pandemic time can feel like a day, or it can feel like 10 years that there were in between 2020 and 22 or 23. Selling Shoeboxed, so we ran a process and actively tried to sell it in 2018. That's when we had run it for 9-10 years, and the investors were kind of coming towards the end of their life cycle on the fund, and we just started the process ourselves. We had chatted with a few different potential strategic acquirers in the past, reached out to those as well as a larger list, and ultimately tried to see, well, what would people pay these days? What would the exit value look like? And is everybody happy with that? There's another great local entrepreneur, Mike Dornberg, who I think coined for me this phrase of, selling a company sucks, having your company bought is amazing. So there's certainly, it's in probably every sales process, there's a lot of stress, a lot of emotions involved, a lot of, is this going to work? What if they retrade? What if this happens? What if that happens? But this one luckily worked out and was a good outcome.
Okay.
And it's funny, a lot of entrepreneurs I talk to after a sale about, what's your first emotion? A lot would say, and that was clearly me, relief. The first thing is you're just, I think, somewhat happy that it worked out. You didn't screw it up.
Yeah.
And there's a check at the end.
That's right. Who knows what the odds are to get actually all the way to exit and getting that check. I mean, 9 out of 10 businesses fail within the first year. I wonder what the stat is for companies that go into due diligence that actually close. It's probably
It's a smaller percentage than you realize.
So you think you've got a deal.
Yeah,
I'm selling the business.
Oh, absolutely. I've seen a lot of false starts with stuff like that. And a lot of it comes down to, and we should talk a little bit about it later on, kind of come back to this idea of what the process of selling a business looks like. I think a lot of people are interested in stuff like that, and even how you go about it when you make the decision. It might be time to look for a partner like that.
Mm-hmm. Well, and one thing I learned switching to this side that I thought was interesting about how many startups survive. In VC, people talk about a rule of thirds in your portfolio, which would say that no matter how good we think we are at picking companies, which we're really not, and this shows, a typical VC portfolio will end up with a third of your companies bankrupt, a third returning about 1 to 2x the money that you put in, so didn't really work, but kind of soft landing, and then only a third being your winners. But I thought that was an interesting stat too, and that's a lot of how especially professional investors on these VC funds think about, how do I construct my portfolio, right? So why do these wins need to be so big? And why are my return expectations incredibly high for a quote unquote winner? It's because they make up for 2/3 of the portfolio.
Sure. Yeah.
that didn't work out.
Back when we were doing subscription businesses, the early internet, so 20 years ago, we ran a similar model for subscribers. We ran a third model. We would get people on a freemium type plan. A third of them, we would assume, would forget to turn it off and renew for 90 days. And then a third of them would for a year. And then a third of those, like you're really whittling it down. So it's not a direct third, but it's a third cut into each 100%, would stick around for much longer than a year. That's how we ran all of our models, and it was pretty tried and true. Yeah. Granted, that was 20 years ago. I don't know if it's still similar today, but I bet it's not too dissimilar.
It's kind of like if you just eat a third of a pizza, you're healthy, but if you eat 2/3, it's bad. And the 3/3, I think a third's can be applied to many things.
To many things.
I really went to
pizza. Yeah, we like it. And there's a lot of conspiracy theories with 33. So.
Okay. Well, that also says that, to me, that getting the validation of raising venture capital puts you in a much better echelon of success. I mean, to say you have a 2/3 chance of at least returning the money and a 1/3 chance of being, a major hit are in some ways great odds. So I think, maybe part of the story is, what does it take to get your business ready to be investable? Because that seems to be a big validation point.
It's a really interesting topic. So on the one hand, I think it is, but I think what you have to really question is causation versus correlation, right? Are these companies getting funded because they were already great businesses and would have worked either way, right? Rather than, do they have a higher chance of survival because they got funded? Or is the idea of being venture funded truly helpful in survival or in good outcome? Having switched to this side, I would say I fight a little bit the battle of VC oftentimes being seen as the holy grail in entrepreneurship, which I truly do not think it is. But whenever you talk to, say, college kids, right, about starting a company, doing something in web and mobile entrepreneurship, they typically think about the TechCrunch cover stories where it's like, oh God, X million from Sequire, and it's all that kind of seen as the holy grail of entrepreneurship. If I could only get, millions in fundings from these VCs. In my mind, I think the holy grail of entrepreneurship still is you running a company off of customer revenue, you owning it 100% or with a co-founder split or with multiple, right? I think that's the holy grail of entrepreneurship, really. And I think VC is a fit for a small portion of companies that need literally millions of dollars quicker than they could get in any other way or through customer revenue, right? If I have a market window, I need to develop technology for a few $1 million first before I can ever make my first cent in revenue. That's where VC can step in and give you those millions that you need before you really make returns. I still think that's a small portion of the company. And I think I talk to people a lot about the downsides of being venture funded too. And the bigger thing I will always go to is control, right? So when you're bringing on your first investor, and I don't think it necessarily matters if that's a VC or just the first angel or something like that, but it is a pretty big shift to where it is not just your business anymore, right? Now you have somebody else, a partner in your business that has specific expectations, that has specific thoughts on how things should be run, that has specific timelines, specific appetite for risk, and that can all be very different from what the founder does, right? So again, you take on an investor, you might not be able to pivot your business around anymore as if you would have if you would have kept ownership of it. And I think there's a lot more optionality basically in a business before you bring on an investor. So I'll keep talking people out of out of coming to us.
Well, there are a lot of threads to go down there, which I think, we talk to founders all of the time, and they do generally think of, raising capital as like one of the top two priorities. I can't even go three. That's probably always number one. They're thinking raising capital. And a lot of times when you dig in, it's more for the reasons you're saying. They think they're supposed to do it. They think that's some key unlock that's well beyond the capital that they get. Having the money is also nice. How do you talk to founders about, this idea of incentive alignment? So let's say you do realize they're a good fit. You do realize that they would benefit substantially from capital and partnership beyond the capital. How do you talk to them to ensure there's incentive alignment and you guys are marching down the same path?
Yeah, right on. It's a very good and big and long topic. So our investment process spans months, right? And that is a big part of that reason is trying to understand the entrepreneurs. What do they really want to get out of it? What is their North Star, and being aligned there. Overall, I think exit expectations, or what you sell a company for, is the one area where you can be very misaligned with your investors. I feel like I grew up with this idea of, well, everybody owns equity in a company, so everybody is aligned, right? Everybody wants the same. The reason that's not true is that on the professional investor side, you have a portfolio of companies, and so you're trying to optimize the value of the portfolio, not of one specific company, right? And it can be beneficial for you to keep trying to drive one company to a larger outcome than a maybe safer early return. And so those conversations are a lot of what I have with entrepreneurs. There is typically, and even right before the end, when we're done with our due diligences, we're going to start the lawyers and start incurring money, I will go and have that conversation with founders again, look them deep in the eye and say, hey, look, just remember, right, we talked about some of these downsides. If I will now invest, say, $1 million at a $5 million valuation in your company, if at the end of the year, that competitor or that strategic that you talk to about a partnership comes around and offers you $10 million for the company, which might mean that you personally could put $1 million or $2 million in your bank account, I will have to veto that. That is not a good enough return for me. So again, right, know that. And if you're okay with that, and if you want to do that too, great. If not, rethink if we're the right partners. So it's about honest conversations at the end, right? It's sharing, here's my models, here's my expectations, what I want to get out of the company. We talk about that very commonly with all of our follow-on investors too. So we're typically very early in a company, right, that then raises a Series A or B, etc. And since we have specific expectations, we do the same with the follow-on investors. And we go and say, hey, how do you see this company? Are you looking for a 3x return in 2 years, or are you trying to get this to a unicorn level and go 10 years and not sell it beforehand? Those are just open and honest conversations you need to have between investors and entrepreneurs to make sure you're aligned.
Yeah, I mean that makes a lot of sense, and I think common to, again, what we've heard is even recently, the market for venture seems to be shifting a little bit, but I think a lot of the young entrepreneurs are still thinking very similarly, which I've got to get investment, and investment means money in my bank and the press release. So it's good to get these things out there.
And I get its validation, right? There is, I think the hard part in startups is there isn't a playbook. So there isn't typically the objective check into of, am I doing well or not, right?
Yeah.
It's not you starting to go to the gym. And you can check in every few months and be like, how many pull-ups can I do now versus 3 months ago? Or, right, like in a lot of our lives, there's kind of check criteria. I think in starting a company, there's not really, right? You start and you go 6 or 12 months. It's like, have a customer or two, and I have this or that. Like, is this good? Is this bad? So I get how it's a checkpoint. And I get to how it might calm you down a bit of there is somebody else, there's a partner in the business, right? It's not just me trying to do it on my own. yeah, I think you can have those checkpoints too on customers, on revenues, right? If you
Right.
celebrate those milestones of getting to the first 100K a year, that could make one founder self-sustaining, right? Or then 2 and 3 and 4 and so on and so forth.
You bring up a good point that I talk about a lot, which is this idea that there isn't necessarily the same linear path for all founders and startups, because people are different, and the people and the way they want to run their company and go to market are different, and that's okay. And ultimately, that's what leads to diversity in product and offerings, and the same thing with funding. There are many ways to capitalize your business, and so evaluate all of them before you think you have to go in the linear path of getting a VC to come in and partner. For many businesses, it's a great idea. For many, it's a terrible idea. And then there's all sorts of flavors in between.
100%.
So
I want to go both like upstream and downstream, but to go maybe, I don't know which one represents which, but for founders to get ready to be a viable candidate to have a conversation with co-founders, I'm not sure how if you still see this, but the kind of common misconception of like, okay, I have a great idea, I raise money, then I can build my team, and then I can kind of build some products, and then I can make some sales. I feel like that's an impossible ask. Maybe speak to, do any pitch decks get funding because it's on a slideshow in the back of the napkin, and like, that's such a great idea, I will fund it. And assuming and maybe there is some of that, but I want to move into then for those early, super early stages, like what is there is no playbook, but what are some plays they can run to try to get to where they're at idea to now I have a good enough business?
It's a really good question. First of all, yes, there is some people that get funded on the idea of a napkin. That is incredibly rare, right? It's typically when you have existing relationship with somebody and they're doing something again, I would say, right? So let's say we had a portfolio entrepreneur and they did, ran one of our companies that had a successful exit in, say, a niche CRM. They would come back to us a few months later or a couple of years later being like, guys, I see a gap in the market. I'm going to do this again. Here's the gap. This is where I want to play with a CRM this time around. I think I need like $3 to $5 million. That way, I can get my old CRO back and I can get that person back and this and blah. And, I can run for 3 years and do X, Y, Z. At that point, you might go and be like, yep, makes sense. Go for it. Good luck. While the other thing that's hard is, I think, this idea of how do I organically, I think in an ideal world, you organically run your startup anyways. And you can, get an influx of capital while you're running it anyways and while you're progressing on what you're doing. There is a few problems, of course, involved with that, which is, well, do founders have to work for free and for how long, and who can afford to work for free for how long? Are you not able to hire employees then, or even outsource development, right, or something like that? And do you need the first money for it? So with that said, I think it's, what we would need, I'll go to that question first, and then I'll do the circle back around to that kind of how do you grow it organically. For us, while we still say nothing is generally too early for us, we can invest in a company pre-revenue if we know a market very well. Otherwise, we do like to invest, I would say roughly, call it 50,000 to 500,000 annual revenue is kind of this idea of a first handful of customers, right, and something out there. But with that said, what we then tell people, what we need is just a full-time team. We're not going to deal with people that, do this moonlighting or something like that. Also, this is a funny story. When I say full-time, we don't mean 40 hours a week, but we mean this is your gig. There is still a lot of entrepreneurs that come to us and say, well, I still, teach 2 days a week, or I still do clinical 1 day a week if I'm a doctor, or I still do X, Y, Z. But don't worry, I've spent 40 hours on this business. I can go into detail why that's often not enough. But so I think in an ideal world, what you do is you and the co-founders start working on a business, and ideally you can either support yourself or the founders can, or you do it on evenings and weekends. And then I think there is a first pocket of money that can accelerate you. I talk about grants and prize money actually a lot before I even talk about family and friends, then angel investors, and then venture capitalists. But first of all, we live in an amazing state where we have the NC Idea grants. They are magical, right? It's basically free money that people can get up to $50,000. That can help you, right? Get your first employee, or get, a first designer hired for a project, right? Something that you can do yourself. Or whatever, travel to your first few customers and try to sell some people on a PowerPoint slide deck. So I think you can get money there, and then ideally it starts growing organically into some of these other funding sources. I think that's the ideal part. Well, again, it certainly can happen if it's the right person, the right market, and something that at the end of the day just investors know, either the person, the market, or ideally all of the above.
Yep.
Then you can certainly get that check on a napkin.
Yeah, no, that's great. I don't see it, I mean, it's up to the individual entrepreneur to figure it out, but I mean, running an agency, we are sometimes the first stop of someone being like, all right, well, I'm gonna get this idea, I need a quote, I'm just raise some money, and then I'll quit my job. And then they're thinking about things, but they haven't thought it through of how it will actually work, and they have definitely not married that with what is reality. But you mentioned, I mean, that's not encouraging. I mean, the opposite of that being encouraging would be entrepreneurs for like people who already have enough access and privilege to sort of take a risk, and kind of they've got money in the bank and they can float themselves and they can get it far enough to get some of those early stage of fundings. But I didn't really hear that that's the only way. I mean, you can moonlight while you get some things going, you can find some partners, you can hustle it up, maybe get a product made, maybe not, maybe just get to where you get a grant, maybe there's a few other pockets that are out there. And that gets you far enough to get to the next stage and the next stage and the next stage. It's not necessarily you've got to just do, the load is lightened from zero to venture. There are a lot of steps along the way. And I hope that people, I don't know if there's like, maybe the ecosystem app will show you exactly how to do that.
We should talk about that. It might be helpful.
Yeah, I think the one, sorry to interrupt, the one thing I would still add, I think, is I would think about it in terms of business milestones rather than the funding milestones, right? It's it's about building a business, and then if venture capital, if angel investment makes sense for that business, great. But I think, as you said, I think I would think about, well, what do I need to get to revenue? What does it take to get my first dollar in revenue in, right? Can that be me moonlighting and on weekends? And then is it me building an MVP, or is it me just building a PowerPoint slide deck and getting somebody sold on, hey, I'll deliver 6 months later? But I think that's really it, right? It's just what do I need to get to a first revenue? And you figure that path out, and then you can go from there on, all right, so now how would I go from the first revenue to $1 million a year? What do I need for that? Can be funding, can be people, can be other things. And lastly, I would say, just talk to people early on about your journey and your specific situation, right? We are more than happy to talk with our lens is B2B SaaS, right? B2B software, ideally enterprise software. But any founder in those realms, come to us and chat with us and say, hey, here's my idea. What would you think? Like, at what point do you think I could get angel capital? And who around here writes these checks? Or what do you think it would take for me to raise 2 million or 5 million? And who would that be? So start talking to investors early on, hear what their maybe general criteria is, but then also try to get them to break it down to your business and what they would want to see.
I have a deck that I got on Monday, and the roadmap, I kid you not, you know who you are if you're out there listening, was Series A, Series B, Series C. That's how they define their milestones, how they're going to raise capital.
Nice.
It's kind of interesting. Like, not good. I was going to say,
I cringe whenever I see there's every now and then a pitch deck that has the exit outcome in there. Right?
Yeah,
and it's well, you invest now at this, and then look, I'll be at 54 million revenue in 3 years, and on a ridiculous multiple that I found somewhere. I'm gonna sell for 900 million.
That's right.
So you're gonna make a 340x in
Yeah,
return
I love
if
it.
you invest right now. It's like, oh well, I guess it's all figured out here.
Yeah.
Nothing could go
I was-
wrong.
I was gonna say it might be helpful because we didn't really dive in, so people know really where you're coming from on the co-founder side. Just kind of talk a little bit about co-founders, who you are, what you generally do, and where you're coming from.
Yeah, right on. So Cofounders Capital, a local fund here, as you said in the beginning, Nick, founded, or all three partners are former entrepreneurs. So we all sat in that founder, CEO, COO, etc. chair for longer than we've been sitting in our investor chairs now. And really, it was started in 2015 by David Gardner, serial entrepreneur throughout his whole lifetime here in North Carolina, then pretty active angel investor and mentor, because of the heavy demand and supply gap that we see in early stage funding here. I think David put it so fittingly that he said, I think it's ridiculous. We ask our founders in North Carolina to raise their pre-seed or seed rounds a 20K angel check at a time. There just wasn't any good institution that could write those first few 100K checks, right? Or that $1 million check or something like that pretty early on. So typical entrepreneurial fashion, he said, let me take that upon myself and see if I can raise a fund together. And then my partner Tim joined him very shortly after that. And then I joined those guys a few years ago. So overall, we still have an entrepreneur heart beating in our chests, and we can't hold our feet still. We love the idea of working very actively with our founders. So we love to understand a story, what somebody is trying to do, where they need help. We still say the biggest criteria probably, because B2B software still is very broad, right? In a lot of different verticals. It can span from healthcare IT to marketing tech to HR tech to insurance, fintech, etc. The thing that spans our investment more really is the question of, can we help? Is there something that we could do? And that's very individualistic on the companies and the founders, right? Maybe we can help hire your management team. Maybe we can, maybe we know your customers and we can get leads or get that first beta customer sold, or we can work on channel distribution partnerships with you, or pricing strategies, or whatever it may be. So that's overall the spiel and what we like to do. In terms of numbers a bit more, so we're investing out of our third fund. That's a $50 million fund. And with that, we typically write $1 million to $1.5 million initial checks, which allows us to keep about 2x of that in reserve. I would say, well, I've been down on VCs in this episode here. The one advantage I would say to having specifically VC investors is they will typically have reserves for a company, right? And an angel might not, or might have not parked it, right? If you get a 100K check from an angel and you come back to them 4 months later and be like, ooh, by the way, I kind of need 100K more, they might go, well, I don't have it. For most VCs, you will reserve a specific amount for a company, and that can be incredibly helpful, getting somebody through crisis, through maybe a downturn of some sorts, or just, signaling to the market, hey, I'm participating in that next round. I really believe in this company. You should invest too, kind of thing.
Yeah. I am hearing both that the point of a company isn't to get venture capital, it's to have a successful outcome. And an outcome is, the beauty is in the eye of the beholder sort of thing. Like, what does that outcome look like? But at the same time, where investment is going is something that all market participants need to be aware of, even if your goal is to bootstrap forever. But if tons of money is pouring in, that might be pouring into your competitors, which is a risk. It might be pouring into your customers, which is an opportunity. So following the trends, so I think it's not wise to just say, look, I'm never going to worry about that. I'm just going to have a good business and not think about what the market is doing. We talked a couple months ago at this point, about sort of the trends on more of a macro basis, like even annual, like seed and follow on seed, and one kind of always precedes the other, and we're in a bit of a cycle. I think a lot of where we are, and still Q1 2024, people are down on the market, like, oh, it's venture capital's dried up, or just people are waiting until a few things happen and then money will loosen up. But where do you think we are? Maybe if you want to tell us kind of where we were and where we are now in the market.
In kind of funding environment in general, of how easy or how hard it may be to raise.
Yeah.
Yeah, absolutely. Well, first of all say I think that's a really good call what you made on staying abreast of what's happening in funding, even if you're not funding. I'll give a quick story, I think, why you just pointed me at. There is opportunities for entrepreneurs, right, to based on funding environments. And there was a local story here that I loved, and an entrepreneur named Josh Miller. He's now in his second or third company with this company, Gradient Health. Maybe about 4 or 5 years ago, we started seeing a lot of computer vision medical imaging AI, right? This idea of I can, based on the lung x-ray, I can tell if you have pneumonia or not. Or based on a brain MRI, I can tell if you have a tumor, or based on, right, kind of these images, a computer vision can tell what your medical condition may be. We saw a lot of those plans coming up, and typically always individual pathology. So I can specifically figure out lungs, so I can specifically deal with x-rays, I can specifically deal with MRIs and train the models on all of these conditions. Maybe a year or two after we started seeing a lot of those, we met Josh Miller, who came up with the idea of saying, well, what do all these people need to build their algorithms? They need a big sample set of images and a tagging tool. So he built a tagging tool for medical imaging AI and said, I can deliver images to you. So I can, you can go on here and say, I need 10,000 MRIs with these and these conditions. So I can start training my algorithm. I can use the tagging annotation tool to build it. But that was a terrific idea, I thought, on it's this idea of, let me build the shovel for the gold rush. Right? Let me not go gold mining myself, but how about I'm the supplier of shovels? And I think that's a really smart point for entrepreneurs to look around of where's money going, and could I be the shovel to those markets potentially? So with that said, kind of where the markets are. A long story short, I think for me is to say it's always up and down. That shouldn't necessarily influence when you start a company or when you raise two. There will always be some investors in every market that invest. It may just be harder or easier at times. What we're seeing right now is, I think we saw a somewhat ridiculous, frankly, boom shortly after the pandemic. Right, so 2021, 2022 were years that were described as capital was almost free. Everybody wrote checks, interest rates were incredibly low on debt. You just had an amazing amount of money in the market that needed to be deployed somewhere, was being deployed, in that did a lot of interesting things. It made terms incredibly high, valuations high. It made due diligences pretty short, risks weren't quite figured out, future plans for funding on debt, etc. weren't quite figured out. So especially, I would say, last year and into this year, we're feeling the problems from that time, where people overextended themselves, might have to save some portfolio companies that are struggling now from those times. And I think 2023 really was that first year where we saw a lot less deals getting done at lower terms and things like that. That is definitely going into this year. How much longer? It might be a bit of a depressed, I would say, environment is a question, but that also doesn't mean that, again, there's nobody funding, right? So a case in point is, for Cofounders Capital, we on average make 4 new investments per year. That's been kind of our pace the last 9 years. In 2022, we only made 1. That was the height of those terms, and we just couldn't get our head around how we would make returns on these companies. Last year, we made 7. That was our most active year, in fact. We made 7 investments. And I think it was this combination of, we told some founders in 2022, hey, look, we can't get on these terms. If realism sets in and you want to come back to us a year later, come back to us. People actually did. And said, hey, guess what? Yeah, might have been dreaming about getting a 20 million valuation on my pre-revenue startup. Yep. Now I'm more realistic because I'm either going to go bankrupt in 2 months or I'm going to take whatever deal is out there. So again, this market isn't the greatest, right? No, it's not necessarily you or your company or your business when you get a lot of no's these days. But at the end of the day, what you have to do as an entrepreneur is keep trying, keep going, keep banging your head against the wall until somebody finally says yes. And again, investors invest in every market environment, just a bit more, a bit less. But go out there, meet the people, and make sure you jive with them well. It's a good relationship. It's people you like. It's people you click with, where expectations are similar, and that will make a good path for your company going forward.
Well, investors want you to. There's a kind of a free market kind of mechanism at play, because investors, even though they might be able to get great deals now, they know if they get too good of a deal, you're going to lose sort of founder incentive, and they're not going to work as hard to get the return. So I mean, while the deals might be better now for investors, there's a lot of it's still a fair time to raise money, especially if you're just building. What about the other group that raise money that's high? Do they all just need to like start over and throw their business away because they'll never get the valuation, or is that just a lot of previous investors are in for some pain? How are both VCs and companies thinking about that?
Very, very good question. I think that's where it gets real about how good are you investors really. So there's a lot of conversations right now, a lot of, and we're in the middle of a lot of that too. I'll give you a good example. We're looking at a company right now that we really like the founder, we like the company. They are at a few $100,000 in revenue annually right now, and had raised $3 million or so in the past. One wrong start on a product that they kind of scratched, went a different route. So there's this overall conundrum of, I have $3 million in the company that's only at 200K in revenue. And they raised a lot of that in the 2021, 2022 time. So they raised it at valuations in the teens. I think, have to lie right now, but it's whatever, 12, 15 million. Anyways, it's valuations that is above where the company is today. So we go in to that and say, hey, look, realistically, your company is at valuation X. That's below and maybe well below what you raised the last rounds on. And that's where push comes to shove on how good are you investors. What investors should do at that point is to say, yep, that's exactly right. I overpriced it, I overvalued it, might have made sense at the time based on the data in the market, but simply that was wrong. It needs to be reset right now. So yes, I will waive my anti-dilution rights. Maybe I'll even participate pretty heavily. I might have invested right at a 15 million valuation 2 years ago, and now I'm getting a 6 or 7 million valuation. I'm going to double down. I still believe in the company. I believe in the founders. We just did those terms wrong, and it's the only way how this company will have a successful future is if we're all okay just going blank canvas. What should it be today? How do we change this around? And how do we not hold on to some of the old stuff? I think that's the danger. The danger I'm seeing is people that, and that can be either on the founder entrepreneur side of not being okay with a down round, for example, that I know feels bad, but at the end of the day, it doesn't matter. At the end of the day, it's about, do I have a great outcome or not, right? That's what matters. And so if you have to just kind of cut it down again and say, well, let me restart, and what should it look like today on a cap table, on money, on what rights people have, as long as your investors are okay with it, that's the good part. And the bad part is people holding on to that and trying to get around it somehow and saying, well, let me rather raise maybe a SAFE or convertible note now, and I just have a cap, and maybe that converts lower. Let me get some debt in here, just a small check, and maybe if I sell more next year, or if these market environments get better, then it could work. That's what tends to get companies into trouble, where I think they're much easier, well, easy I wouldn't say, because it's hard on you mentally, but the more successful path, I would say, is you just saying, hey, look, I raised this wrong. I'm gonna, everybody will have to swallow their pride and just, kind of not really restart, but a bit restart on the capital stack side.
I have to imagine when the founder comes to that realization that when they have that honest conversation with the investors, where an investor might not like it, they'll very much appreciate the fact that we're trying to right the ship.
Well, and a third are going bust anyway. A third are going to be single doubles, and a third might be home runs.
I've heard that somewhere.
And your double is a single. Your 1 to 2x might be 0.5x to 1x. These aren't things that are destroying portfolios. Your 10x might be 7x because you had to kind of take a haircut on previous equity raised. But those are still good outcomes. and I think I'm almost wondering, where are all these stats, like the ones that get into due diligence that don't close, that should be a stat, but also like,
That should be.
in some level you could say like most startups do raise a down round, and some probably just go boom, 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 they just hit their timing perfectly, and it's just like up, 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 up. But otherwise, it would seem that it's not actually that uncommon, and so maybe people need to have a little bit of perspective in these times to help them get over the hump, I think, to be okay
especially in technology, because I can imagine all the AI startups come in and they've got a little inflated valuation because of what they hear in the market, and they'll get that from somebody. But inevitably those will crash down to earth, just like the last run. Maybe if you threw a blockchain on your tech stack, you get a little bump for no reason. So yeah, there's an inevitability that many startups will have a down round. It's the nature of the market. Yeah.
Would you call, which was the most famous IPO? Was it Uber or one of them, or was it, I guess, WeWork's failure to IPO, where they had some valuation and now that was a meaningful down round, but it might even be at the very end at the public market level. Yeah, meaning it might be. Yeah.
Well, a lot of those companies, again, the market cycle, that kind of early, the Ubers, WeWorks, anything that was Uber-like, because Uber was such a big hit. A lot of those companies hit this, probably raised at some heightened bubble valuation, and then realize the market economics of these businesses are not actually that good. So you better have a solid plan, otherwise you will either go out of business, you will take it down, you will be in trouble. You'll need more money.
Yeah.
Period.
Yeah. And then I think the other thing is, we still love capital efficient entrepreneurs and companies. The more efficient you are with your capital, the more optionality you'll have to, right? So it doesn't always have to be the next raise. If you have good investors, you can sit down, right, and say, all right, what are all of our paths? Number one, can we get cash flow positive somehow? What would that look like? How much would we have to sell more, or maybe how much do we have to cut, right, in order to get there? But then you're kind of the maker of your own destiny, right? If you are cash flow positive, you don't need to raise, maybe that's a great story. You could also sit down with your investors and say, what if we go soft land now, right? Do you think we should sell rather than going for a down route and trying to keep going? Who would buy this right now? What would that look like? But ultimately, there is never just one answer. There should always be optionality. And as the entrepreneur, you can influence very well how much optionality you have and how many different options you have. And I think a big part of that is how capital efficient you are.
Sure.
Yeah.
Do you have anything else kind of specific?
Well, I was just to kind of close that out. Yep. One thing I always tell founders when they talk about is it a good time to seek investment, is the answer is never no. It might not be the best time for your business. Investors invest. That's their job. Just like firefighters fight fires. That's their job. There's never a bad time for a firefighter to be like, weather conditions are not good enough, I am not going to go fight that. I guess that kind of happens in big fires, but generally speaking, they go and try to solve that problem.
Yep.
And investors, that's their job.
Well, whether you missed it on the way down or missed it on the way up, you still have money you've got to deploy. Even if in a hot market, exactly. You're like, well, I can't not get in. Well, how many gains are you going to potentially sit out on? And are you still looking for the right values and good deals, whether it's an up market or down market? I was just going to say, I think, we've kind of covered a lot, maybe change gears, lighten it up. Well, not lighten it up. I was going to say, what's your why? What's kind of your, venture, you want to have a successful fund, and you care about your stakeholders, your investors, your LPs, your entrepreneurs. That's great, but that's still that's like business, how does that, what else kind of motivates you and drives you?
I'll really start with, it's incredibly fun. It is fun on a number of different ends, and I think those are the reasons why. So I'll start with right after selling Shoeboxed, I took a year off in 2019 and dabbled around in a few different areas as I was trying to figure out what do I want to do when I grow up. And besides the pros and cons list, I also went in and did a few kind of fractional gigs to just kind of try and see what does it feel like going into a company, for example, as a fractional CFO, as a fractional COO, or what does it feel like if I consult a private equity fund that's looking to buy more SaaS companies, or another investor or something like that. And for me, really coming out of this year, it was, I was the most happy when I sat down with entrepreneurs and heard about what they're trying to do, what their companies are, where they're trying to get them to, how they think about returns. When I, consulted for these private equity companies, like what would you sell your company for and why, and what would be success? What are the risks? How do you think about it? That's a part I really loved. So I think it's, first and foremost, it's meeting and working with entrepreneurs. People with fire in their eyes that know their job is to prove the world wrong. They're always going to run into all sorts of barriers and they somehow keep going. It is just an amazing group of people to work with and help and support, all right? And then having these incredibly high highs in entrepreneurship, right? Where you high five, you got that massive customer, or you got that acquisition term sheet, or whatever it may be. That's incredibly fun. Second to it, just seeing what technologies can do is mind blowing, right? And being a bit at the forefront of that. It's I'm really not a tech guy. Nick might be able to attest to that from from the past when we have run into each other. I finally started learning SQL queries. That's about as much as I can do in a tech stack. But it is so fun to see just what technology evolves to, what kind of problems you can solve with it, how you can, build it into people's lives and really make people's lives better. So I think those are all the areas really that make it incredible.
Do you think all VCs feel that way, or do you think some of them just want to get rich at the expense of others?
It's a good question.
That's a loaded question. I was kind of leading
way
you
to
to
put
the.
that.
It is,
Yeah.
and it's interesting. So when I chatted with a lot of people during that time too, right, that were in a lot of these roles, everything from VC to private equity to corporate development, SaaS, etc. I remember this might have been, it definitely was a VC. It might have been Lister Delgado from Idea Fund, who I think gave me this phrase of, there is other industries you could go in to make more money, but I've never seen anybody leave VC because it wasn't fun for them anymore. So VC compared to some of the other finance careers, you can make more money likely in a private equity fund, likely you can make more money in a hedge fund yourself. So if you're driven and motivated by that, you should go to some of the other funds that can just churn compensation for you quicker. But then again, start of my career was Morgan Stanley investment banking. You sat in this little cubicle, 20 hours a day, 6 hours a week, and I think I told people at some point, I might as well type restaurant menus from PDF into Excel sheets, because they just give you a balance sheet and be like, hey, type this up. You have no idea what these companies are. You're just running financial models. You have no idea what the people are, what the strategy is of the business. And that's what you do, right? In private equity or in hedge funds or in some of these. And it is just so much more fun working with people, working on building things. And that's what does it for me.
A little bit of a pressure cooker.
Yeah.
This is not a pressure cooker. But a lot of, it's interesting you say that, because I've heard a lot of people get out for, and this is very anecdotal, for one of two reasons. One is they just are not good at it and thought it would be easy. Or two is they don't like the pressure from their investors.
Mm-hmm. Yeah, it's funny, and we will all say that we all hate fundraising, but we did as entrepreneurs too. I also didn't like it as an entrepreneur, so I think it's only fair that I still have to fundraise now every 3 to 4 years, right? And I still hate it. And it's an interesting, that I would say is really an interesting conundrum for us as former entrepreneurs, because at the end of the day, our job is to make our investors money, right? So with that idea of an entrepreneur heart beating our chest, we also know we can do this for potentially or hopefully decades here if we don't produce returns, right? So do we want to be fair? Do we want to give entrepreneurs great ownership stakes? Yeah. Do we also need to make sure that our fund is going to make a good return so that in 3-4 years, right, I can collect money for the next fund again and again fund 20 entrepreneurs out of that next fund and then do it again and again and again. That's definitely an interesting one.
I kind of view it as it's a company in and of itself. A lot of people, especially founders, the first time they get through it and start talking to people and they get nervous and all this stuff, they don't realize that the VC firm, is a company, and it is trying to do exactly what they're trying to do, which is develop a great product that creates returns and sustainability and impact.
Mhm.
I mean, ultimately, that's all it is. It's a services organization.
It is. It's again, it's the same people, of course, right? That you are. It's the same goals. There is. I had a great mentor during the last company on sales and business development, because I still think I'm a pretty terrible salesperson, mostly for the reason that I just can't deal with rejection. Whenever somebody says no, I like get my nails in the wall, be like, no, I gotta sell you, and I know that's incredibly wrong to be a good salesperson. With that said, at the last company, kind of the last few years, we started getting into partnerships with banks, and we're trying to sell the big banks like an Amex, a Capital One, etc., on integrating our product and some pretty big deals. I was the one who led that, and had this great mentor that helped me on, right, how do we price it, how do we get these people to buy, what are these processes, etc. A big thing that he told me that I don't think I was on before, and I think a lot of entrepreneurs have that problem with investors. His big thing was, when you go into a meeting like this, or anything that you do with that potential customer, it's got to start out as a peer-to-peer relationship. You are not begging. And I think I often did that. I would go to MX basically going, please meet with me, right? Like, I'm this little startup, you're the big MX, can I please come to your tower and take an hour from... That's terribly bad, right? That's not going to make it a good partnership. And same with an investor. That can't be the starting point. It can't be a like, oh God, you rich capitalist, can I please get... It's a, come on in, let's see if we like each other, let's see if we could help each other out. And if that's a great partnership, let's go. But it's not going to help if it doesn't start out as peer-to-peer, and I think that's what it needs to be.
Yeah, exactly.
I think I want to make a statement, see what your thoughts are. And it's kind of about, I want to talk about two things, community and David Gardner's condo at the Novus. But,
all right.
We're going to get very local.
Yeah, very local. Well, so
we thought, now that we have an office again, right, in downtown
it.
Durham, the one thing that we talk about every week is if we can build a zip line from his tower into the truest building where our office is. So maybe Durham will get a long zip line in... I think the plan is at the end of the year, beginning of next year.
Maybe,
right?
yeah. Well, because I think we're always like, community. And at one point there was a really strong, tech and entrepreneurship community. And I'm not saying it past tense, but, in Durham and the Triangle, that we got a lot out of both personally and professionally. And I think some of that's actually kind of changed to where you can be like, I have community personally, like I shop at local businesses. I see some people at the coffee shop or bar. And then there's professional, which kind of just looks and feels differently. And those, I have somewhat feeling, some of this is COVID, obviously, because you got to work and you're working from home and you're not really going out. But I haven't seen those two things converge again. And so I'm just kind of wondering what your thoughts on that and how that props you up and impacts you on the business side and personal. Obviously, none of us have friends, and personally we're impacted, and you need human interaction. But I like it when there's a business and a personal overlap.
I do too, and I'm not very happy about, I feel like, how the world has swung back from the pandemic either. And I think in my mind, I think this is very, of course, personal preference and subjective, but in my mind, I would love to be back where we were in 2019, with people being in an office building during the day. And to be fair, maybe, yes, I mean, there's all these advantages working from home. Maybe that 4 day a week in office, 1 day a week from home is could be ideal, but I do think we lost a lot doing it. I recently saw a buddy of mine for his 40th birthday. We actually went to college in Germany together. He lives in New York now, and a couple of years just moved out of the city to New Jersey and bought a house, has 2 kids now. And I quizzed him on, hey, so what is it like? Like, do you miss the city now? And he says, the one thing I really miss is what was typical over there was on your way home, you would stop somewhere at a bar or at a friend's office, or you would see somebody on the way home. And that I don't do anymore. And I think that's true for a lot of us, right? Especially when we're maybe working from home a lot. You don't then go out to meet somebody. While I feel like it was so natural, and that's the thing I think I missed the most, is this idea of oh, my last meeting today ends at 4:30. Anybody want to grab a beer for an hour, and then we'll all go home at 5:30. Those are the ones I think I miss the most.
Yeah, go ahead.
Yeah, I would say I think even in big office spaces, this idea of serendipity and the serendipitous, like we crossed paths on the way to the bathroom, ended up in a conversation which led to an idea. That happens in office. You can't, you just can't replicate that.
Well, just because it's tech and venture doesn't mean there's not a local component. Like, a lot of your contacts and relationships and LPs and how you'll grow your investor base, how portfolio base has to exist from some kind of reach. And it's not necessarily going to be your thought leadership on your blog. You probably have to be in spaces that people are in. And I think I'm also just kind of stating a concern for how we've bounced back from the pandemic. And it feels like you can get what you need personally if you seek that out. I can call friends, and that's a special trip. And, let's all meet at a place. And we all have to okay, it's a big lift. And then there's, professionally, which feels like there's not the same leadership as there have been before, where it's like, who's kind of making sure we're all trying to rise, rising tide lifts all boats. So the rumor, that I've heard about David is there's a new condo building. So I'm really grateful. You live downtown, or downtown-ish, at the old Foursquare place. And I live in South Durham, but we obviously office here and own this property in downtown Durham. And the Novus is half a mile to 3/4 of a mile down the road, right in downtown. It's a beautiful condo building. And I'm always excited about more people flocking to Durham and living and saying, I'm going to do everything here. I'm going to live here. I'm going to spend here. I'm going to invest. But I feel like buying a condo is what some people would do. But I've heard David's bought 3 condos. So he's got a penthouse. He's got 2 others. He's going to attach them. How many condos does David have in the Novus?
Actually, you might have to ask him. I'm trying to think if I do think it's either 2 or 3. But he's moving his parents in there with him. And what I don't remember on the 3rd one, if his daughter and son-in-law are coming in with him too. So I think it's 2. I think it's he and his wife want to ultimately downsize, right? Their thought is, look, kid out of the house. Why do we have so much property that we need to leave below and deal with? And wouldn't it be fun living downtown, walking distance to DPAC, to bars and restaurants and the like? That was really the thought. With that said, he then David still has both his parents, both in their 90s, that live around the corner from him, and so he's moving them with him. And then, I can't remember. Maybe there's a 3rd, but
a good guest house.
I was gonna say for the dog.
Yeah, exactly. Guest house condo, changing room condo. That's great.
Maybe the Cofounders Capital office.
Yeah.
There you go. All right.
Why not? All right, Eric. What else do you got as we wrap up?
I think we covered a lot of good ground. I think it's very, very beneficial. And these are the types of things, I think a lot of people might be sick of hearing COVID, but I think this thread of COVID we should talk about for a long, long time. Just so, because if you can get through to just a handful of people on, I never thought about the things that I'm missing by not getting out more frequently, then that's a win.
Yeah.
I totally agree with that. I saw, this is now a while ago, maybe it's a year or so ago, Doug Kaufman, who a lot of you all will know, gave a good presentation at American Underground about mental health of founders, especially post-pandemic. One thing I remember he coined that, of course, makes sense when you hear it, is that human connection is still made physically, right, and geographically. So his point was, even if you have people you like at work and you're on 4 or 5 Zoom calls with them over hours every day, the bigger human connection is you talking to a barista for 30 seconds. It's that face-to-face. Zoom doesn't connect us, right? It's still about being with other people, being close, having conversations back and forth, having eye contact, and all of that. And I think that's important to us as humans. So that's certainly a topic we should make sure we continue. We don't all sit in our house in front of our screens 24/7 at some point and fed and dressed by robots. So
Wall-E.
that would be a grim picture. I feel like that would not quite be life.
That's not life. You guys have seen Wall-E, the Disney movie, where he's the little trash compactor, and people have moved off of Earth into a spaceship or whatever, and they all
And
are
all the
on,
robots do everything for them.
the robots do everything. They all are on floating, like basically recliners. Things show up, give them drinks, and like they show the picture of like the captains over the generations, like looks like a regular human, and just all the way to like blob, and they can't even move.
There you go.
And I was like, wow, okay, I guess that's where I love the political commentary in some of these. But I think so. As we close up, I think that's a lot of good stuff around adventure and mindset of entrepreneurs. A good thread to pull on of community leadership and why there is a benefit, like and having an acknowledgement of the rising tide lifts all boats. It will be like, so therefore if you are out and we're doing stuff that we can kind of connect, we don't know what that might lead to. It might be nothing, but by continuing to be there and show up and be intentional, I think that is going to be important as we sort of establish ourselves as a leader in the market, as a great place for entrepreneurs, for investors, because we want both. We want investors to know, like, oh, if I invest into a company in Durham or the Triangle, that's great. Or I'm going to invest into a fund there because they're the shit, and it's because we're all doing this great stuff.
I don't.
And I think everything you said, knowing you for over 10 years, is totally true and authentic about you. You like it and you really enjoy helping others. And that was a good take. That was a great sales pitch for VC. Like, I think that VC and capital people get a bad rap because some of them are just using money to make money, and it's very nameless, faceless, soulless. But I like that perspective on venture and how you approach that and the impact it makes on people.
Yeah, I mean, overall, I will say it is a tough position, right? Like you have this kind of two-parted side, to your point, Eric, on you do think a lot and stress out about what do my investors think of me, right? Just as an entrepreneur, but you still have to perform there. On that bad rap, I think it's a lot of people finding comfort ultimately. We have all had stories before of what we liked in VCs and what we didn't. And I think it's the people that are just very comfortable at the end of the day, that have the realization of, well, look, I'm not going to change a company, right? I'm trying to help. I really do. I spend a lot of hours doing it. Is my contribution to that company's success more than maybe 1% at the end of the day? No, right? 99% is the founders and the teams. And yeah, maybe I can help with 1%. But I think it's that realization. I'm not going to make or break a company, right? It's up to the team, and I'm just going to try and help the team and support them. And I think it's finding the comfort on those outcomes. I remember my last VC, that was Jack Biddle, a guy I loved as a VC. He at some point said, I'm trying to teach these young VC kids that you can't own more than 100% of a company. And it takes a while to think about that, but it's super interesting. Like there is, what we see in our world, there's a lot of people that get incredibly cute on terms, right? Like, could I get dividends here, and this liquidation preference, is this blah, 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 blah. And to Jack's point, it's, well, look, if the company is going to sell for 2 million, you're still not going to make 5 million off that. No matter what your terms are, you can't make more than the company ever becomes, right? So pick great teams, know that 2/3 are not quite going to work out, and follow along and see if you can help a little bit, right? And I think that's ultimately all we can do. And then it's up to guys like you to make it.
All right. Living the dream. All right, taking us out here. Thanks, Tobi.
Thanks.
All right. Pause. What do we do now? Okay, it's off. Sweet. That probably went to sleep after like 5 seconds.